Hey, thanks everyone for tuning in this afternoon. We've got a lot of good stuff to go over, and my name, as Dave said, is Tim Racette. I blog over at EminiMind.com, and I'm going to be talking about two strategies that you can use for day trading the E-mini futures. And the examples that I'll use in the slides today will be from the ES, but you can use these strategies on whatever market or time frame that you trade. It doesn't have to be the futures markets. I just choose to trade the futures because there's a lot of tax benefits and some other benefits that we can talk about as well. So we're going to run through these two strategies. I also have a couple of slides that I want to touch on regarding trading psychology and a whole lot of other good stuff. So we're just going to dive right in. So a little bit about me. I've spent a lot of time in the outdoors when I'm not in front of my trading screen. And I've been trading since about 2006. And I find that the markets have changed a little bit over the years, but for the most part, the simpler you create, the simpler your trading strategy is that you've created, the easier it is to withstand a career in trading. So I've had the pleasure of speaking at a number of these festival events, as well as the CME and Traders Expos and things like that. So I primarily day trade futures. I also do a little bit of swing trading of stocks. That's actually how I got my start, was swing trading daily bars, and then added in the futures a couple years after I was swing trading. I grew up in the Chicagoland area and went to ASU for college, and that's kind of when I got started trading. In my early years, I got some exposure to the Chicago Board of Trade downtown, had the opportunity to go down there, and Chicago had a whole lot of just opportunities for traders and even investors. And so being able to go downtown to the Board of Trade, meet some guys and gals down in the pits, they kind of were mentors to a friend of mine and I, and we kind of learned to trade from some traders down in the pits, as well as some folks who'd been trading on the screen really since the 80s. So it's always nice to find a community of traders that you can bounce ideas off of, or at least have a trading friend, or even if they're not necessarily in the trading space, just someone who's kind of got that entrepreneurial mindset is a really helpful way to kind of have someone to talk about some of this stuff with, because it can get kind of lonely when you're just trading for yourself on your computer screen. So like I said, had the pleasure of speaking at a number of the Traders Expos, and as some of the pictures here, getting outside is a big passion of mine. Do a lot of mountain biking and hiking and exploring and things like that. So a nice balance to trading is always to get outside and get away from the trading screen. So this is my chart setup. I have a 2-monitor setup, and I use thinkorswim for my charts, but you can use whatever platform you want. Ninja, a lot of people are on, TradeStation, and it really doesn't matter. Nothing super proprietary to thinkorswim, but I've got one chart set up with one screen with my charts, and then my right monitor has my trade ladder and my trade log. So I just keep it super simple. The chart on the right is a tick chart, which we're going to talk about. Chart in the middle, I toggle between like the higher time frames, just a traditional candlestick chart. It might be on a daily chart, and also some smaller time frames. And then the bottom left, which we're not going to get too much into today, is a nicey tick chart. So the first thing that I always like to start with, because regardless of the strategy you're trading, it's important to understand not just what the trend is, but when does a trend begin. And so if we're looking at a chart, we want to understand the relationship between the swing highs and the swing lows. So if we start from the left side of the chart and we just determine our first point, from that low point, the next swing makes a high, then the next swing makes a lower low, then a lower high, and then in this example, lower low, lower high, and then we kind of have this double bottom that's put in. And it's at this point, when we're in this downtrend of lower highs and lower lows, when we break that swing high and start making higher highs and higher lows, that is the point that we have now begun a new trend. And that's important whether you're trading with the trend, counter trend, or trading a sideways strategy, because we want to know, not just what the trend is, but where are we at in the trend? Are we at the start of a new trend? Have we been in a trend for a long time? Or are we just kind of going sideways with no real structure of higher highs and higher lows, an uptrend, or lower highs and lower lows, a downtrend? So the first strategy we're going to talk about deals with retracements or pullbacks. And so what I like to use is a fib tool. It doesn't really necessarily equate to using all of the fib retracements themselves, but the fib tool allows me to get an idea of where the halfway back point is on a trade, or a 50% pullback, if you will. So the general idea with this strategy is you always want to draw, when you're drawing up the Fibonacci retracement, start from the left side of the screen and go to the right. And so what I'm doing is looking for a 50% pullback to re-enter into the trend. So in this example, market's in a downtrend, then I'm looking to get short, but after the market has bounced. Rather than just chasing the move lower, I want to identify that downtrend and then get into the trend after we get a pullback, so that it can lower my risk on the trade. And so by entering at the 50%, or that halfway back point, 50% is, like I said, is not a fib number. I will use the 61.8, which is a fib number, as my stop point on the trade, but the 50% is just a kind of an arbitrary pullback. That's something that started in the pits. The traders would look at the first hour high and low, divide it by 2, and then that gives that halfway point. And when price would retrace, look to re-enter. If we opened up and moved higher, waiting for a pullback to enter into a long position would kind of be the theory there. So like I said, the 61.8 is a good failure point or a stop point. And I'm going to run through some of these things fairly quickly, kind of getting through some of the basic stuff into the more intermediate to slightly advanced concepts. And if anything seems a little bit foreign, or you're left kind of scratching your head, you will be able to review the recording afterwards. And I'm happy to send out the slides as well if you want the notes and things like that. So we'll run through a lot of this stuff fairly quickly. Then you can kind of review it or go a little deeper into areas, researching or doing your own analysis, down the road. Because one of the things about trading, it's more important, I've found, to go deeper into the areas that really resonate with you, picking a strategy and going deeper into that strategy, as opposed to being very broad and wide with your viewpoint, with the markets that you're trading and the strategies that you're looking at. If you're looking at 10 different strategies and a whole bunch of different markets, it's very easy to get lost. Whereas if you settle on one strategy, one market, one time frame, and really become a master of that, then you can start to add, as you develop the skills and kind of master one thing at a time. So the 61.8 is a good failure level. And then the other fib number that you can use is either a negative 23.6. Sometimes it's viewed as 123.6, but basically it's 20% beyond, in this case, lows. So after breaking lows, moving another 20% beyond that can be a good target point. You don't actually have to close the trade at that level, but just kind of get an idea of when we make a new low, where might the market head towards? And that negative 23.6 is a good place to use that. So the idea is then after we enter on a 50% and make it down to a negative 23.6, to then draw the next retracement and either continue to trail your stop above that 61.8 and then draw up the next retracement and continue that progression, or re-enter, close the trade and then re-enter. That works as well. And regardless of the time frame that you're using, like I said, always starting from the left side of the chart and moving to the right. So when it comes to executing the trade, it's really important to wait for a break of a swing high or low, going back to the swing highs and lows that we just talked about. So waiting for a swing high to break and then watching for a pullback. If you're just in a series of lower highs and lower lows, lower highs and lower lows, trying to take a long without getting a swing high break, there's no signal that the trend has the potential for changing. But if we are in a downtrend and we break a swing high, now we have sort of the catalyst for a new uptrend to form. So wait for that break of the swing high. If you're looking to go long, draw the 50% retracement. And then I like to just kind of round up and add a tick. That way, if price does happen to touch the 50% cleanly, it ensures that I get filled, since price, 9 out of 10 times has to trade through your order to get filled. And then I use a really tight stop on the ES, and I'm particularly, most of the time I'm trading on the 512 tick chart. So if you're looking at a 1 minute chart, a 2-point stop is also fine. I won't go into too much detail on how the tick chart is set up, but some people use Renko bars and things like that. But the 512 tick chart is a very short time frame. And then I also put a Heikin-Ashi candlestick study on it. That's why this chart looks so much cleaner. Like the string of green candles and then red candles it really smooths out the chart. And then that's also why I can get away with such a tight stop. So when it comes to trailing your stop, I mentioned trailing the 61.8. That's a really good place to stick a stop. You can also trail your stop below just the swing lows by a couple of ticks. And if the market really gets moving fast, you can trail each candle. And sometimes, like especially if the market starts selling off, I'll just drag my stop down on the trade ladder as best as I can, a tick or two behind each candle. So these are kind of the options laid out. That 61.8 trail is the most conservative. A little bit tighter, you can trail the swing highs and lows, and then even a little bit tighter than that, you can trail each candle. You can also use, since you're using a 2-point stop, an 8-point target can be a really good way, especially if you're first starting out, to kind of get some wins on the board. That's a 4-to-1 reward to risk, so that's really good ratio there for an R multiple. And so if you want to use an 8-point target, that would be another option. And as you get into multiple contracts, you can do a variation. You can have your 2-point stop, 8-point target on half the position, and then you can continue to trail your stop on the other half of the position. And you don't want to overcomplicate it, but as you get into multiple contracts, there are more opportunities for staying in those winners longer. So then the next thing I want to highlight is the 30-minute opening range, meaning from 9:30 Eastern to 10 o'clock Eastern. And that's a really good point to be able to determine if we're trending or if we're range bound. So on trending days, we will tend to break out of that 30-minute range very quickly, and then we can just go with that trend. If we break to the upside, buying pullbacks. And so like this is a 15-minute chart. The 30-minute range is down here where these two gray horizontal lines are. So even if you don't trade retracements, just knowing that the first 30-minute range is a very telling range of, if we stay within it, then by definition, we're range bound and we're likely to chop around. We can fade highs and buy lows, especially if that range is wide. But on trend days, we're gonna form that, get to the 30-minute mark, and market's gonna break one way or the other, and it's gonna keep going. And so a retest of the 30-minute high is a good place to look for a pullback into a long. And by the end of the day, that 30-minute range is going to be pretty tiny relative to the entire day's range. So this would be an example of buying a 50% pullback at that gray line, which was the top of the 30-minute range. The other thing you can do is look for support or resistance on a larger time frame. So look for a retracement on the 15-minute chart and then come to the 512 tick chart to place your order. You're going to have a smaller drawing. The distance between the 50 and the 61/8 is going to be smaller, and thus you can use a smaller stop. You can also just look for any support and resistance level on a higher time frame and then place your trade on the 512 tick chart. So the second strategy that I want to talk about is the what I call the 1-minute hammers and inverted hammers. They're also called pin bars. A lot of different names, but in general, what we're looking to do is buy pullbacks the same way we would with retracements, but instead of buying with a limit order at a 50%, we're looking for hammers and inverted hammers to get long above or below. So a hammer, just a small body, less than a third or less of the entire candle. If you include the wick, the body should be about 1/3 or less. And that's what makes up a hammer. Price moved down. At one point, this red candle, or this hammer, was a big red candle. And then price rallied. And by the time the candle closed, it was closing near the open up towards the top of the candle, which forms the hammer. And then you're getting in with the momentum on a break above that hammer. So looking for hammers in uptrends, that's key. We want to go with the trend. Another helpful tool is the 21 EMA. I don't put a lot of indicators, really any indicators on my chart, but that 21 exponential moving average is very helpful when you're using a 1-minute chart and just looking at these basic candlestick patterns. You can pair it with a pullback to a 50% retracement, and you get a hammer long. You get a hammer for a long entry. That's another good pairing. And then double bottoms are also good places to look for longs. If you were to turn the chart upside down, then just doing the opposite, looking for an inverted hammer, going short below it, particularly in a downtrend at the 21 EMA, kind of all turning everything upside down at a double top, at a halfway back short. Looking for things like lower highs, because if we know a downtrend is made up of lower highs and lower lows, then once we get a lower high, breaking the inverted hammer, breaking the low and getting into a short solidifies it as a lower high. So when it comes to managing the trade, what I like to do is use a 3-point stop and a 6-point target. So keeping it pretty arbitrary and structured, 2-to-1 reward to risk. And if the candle is smaller than 3 points, I'm okay tightening the stop. Like if the candle was 1.5 points, then 1 tick for entry, 1 tick for stop, that gives you a 2-point stop. So I wouldn't go make it larger than 3 points. Let's say the candle was 4 points, then just using the 3-point stop is fine. I want the trade to go fairly quickly, so I don't want to retrace the candle by very much. So 3-point stop, 6-point target, 1-minute chart, 21 EMA, that works super well. And just looking for these pullbacks kind of towards or to the 21 EMA on the 1-minute chart. You can use a larger time frame, but I find that there's plenty of entries on the 1 minute chart, and the more you look at one market in one time frame, you can start to assimilate and kind of parse out the noise from a clean trend and a clean setup. So a downtrend would just be this chart upside down. Downtrend, lower highs and lower lows. The 21 EMA, it just makes a nice clean visual. You want kind of a down and to the right 45-degree angle. That gives you a nice downtrend. You get an inverted hammer, and if you look real closely, the key to the hammer and inverted hammer is that the tail needs to stick above the prior bar for it to be a kind of solidified swing high. Like the tail of this inverted hammer is above these last two candles. That makes it a very clean inverted hammer. The one before it is kind of an inverted hammer, but it's just an inside bar. And so I wouldn't really look for those as shorts. I want the tail to stick above, or if you go back down here, this hammer, it's in a downtrend, but just for the example of the tail sticks down below the prior bar, and that's key. So when it comes to trailing the stop, I like to just trail swing highs and swing lows. So if I was entering above this hammer, and it really doesn't matter if the hammer body is green or red, but getting long above the hammer and then letting the market kind of, you want the give it a little bit of couple of candles to kind of trade away from your entry. A lot of people move their stops really quickly on like the ES and the NQ, and they want to just have a high winning percentage, but then you end up getting taken out of trades before they even have a chance to work. So you got to be patient at the start, let it get away from your entry, and then when it pulls back and breaks to the upside again, then you can bring your stop up underneath the next swing low and then the next swing low, and just keep trailing it, and you're going to have that 6-point target out there. So you're kind of bringing your stop up from the bottom and prices rising towards the 6-point target. And then again, as you get to more proficient and you have multiple contracts, you can split the position in half. Let's say you're trading 2 micro or 2 mini contracts. I guess it doesn't matter, micro or mini. You don't want to spend too much time on the micros. Use it as a practice tool. But getting to 2 E-mini contracts, that's a big milestone. So you could trade one of those contracts with a 6-point target. The second contract, you can just leave open-ended, no target, and just continue to trail swings on that half of the position. I just highlighted here the the break of highs, and that is what solidifies the candle as a swing, a higher low in that trend. So this is probably the most important piece. I know a lot of people like to talk about or like to research in YouTube trading strategy and things like that, but I wanted to touch briefly on a couple of the mindset and trading psychology bits, because just by looking at those two strategies, you think, okay, well, that's super simple. Most everyone in the room can probably get a good grasp of that within a week, looking at one market, practicing, drawing up some fib lines, identifying, the hammer, the inverted hammer. That's really the easy part. When it comes to doing what you say you're going to do, okay, I'm going to enter the trade with a 3-point stop and a 6-point target. Now we start to lose some people. We get, some micromanaging of the position, and I'm up 2 points, and I just had a losing trade. My last trade was a losing trade. I lost 2 points. Now I'm 2 points in the profit, so I'm just going to close it out so I get back to break even. That's a big no-no. And those kind of micromanaging of the positions really is what ends up killing traders. And the more you can be hands off, the better. So just a couple important pieces that I wanted to highlight. A lot of traders fail not because they they don't have a good strategy, at least on paper, they know what to do, and it has a positive expectancy. They fail because they don't understand how the markets end up affecting their psychology. And I've, even folks who have $10 million trading one E-mini S&P contract, it's amazing how the psychology of winning and losing money, being in the green or in the red, can mess with your trading. Even if you could lose 10 grand and absolutely not bat an eye, when you're trading, that psychological piece can really mess with the way you manage the trade. And so we want to focus on maximizing gains and minimizing losses. And that seems, pretty intuitive, but it's important to trade when the markets are favorable. And if the markets are slow and choppy and the chart is a mess and you're really trying to force trades, you definitely want to pull back, sit on your hands, or just close down, your trade ladder for the day and come back the next day. I like to limit my trading to the first couple hours of the day. So from the New York Open, go about 2 hours, and that's it. So, that can help limit any damage if you start to go off the rails. Limiting yourself to a certain number of stop outs is also really helpful. The market is not consistent on a day-to-day basis. So just trying to have a profit goal for the day is, again, not the best way to go about things. My P&L ends up being these bigger winning days and then a lot of no trade days or flat days. And you need those big winning days to offset, a whole bunch of little, scratch days. And when the market is favorable, you want to keep trading. And if the market is choppy or consolidating, that's when I pull back, sit on my hands, and wait for a better market condition to be able to trade. So the mindset really is everything. And whether it's high performance, anything, you fill in the blank: music, sports, business, entrepreneurship, anything that takes a certain level of skill. Someone can learn the mechanics, but adding in the mindset piece is really what makes, just a really good high school football player a great college player and eventually a good NFL player. Being able to think quickly and process and being able to manage chaos, ambiguity, things that go wrong, curveballs, unexpected things. You really need to practice embracing discomfort instead of just running from the discomfort. And that way, a lot of, as we get into the Olympics here in a few weeks, you'll hear a lot of athletes talk about visualizing things. Michael Phelps is a great example. He would visualize all the things that could go wrong. And when he did, I forget which distance it was, but he would visualize having water fill up his goggles and not be able to see. And he'd go through what he would do, how he would continue on and get through it. And that happened. And he still set a PR because he didn't panic. He knew exactly what he was going to do. And he visualized the things that can go wrong. And that kind of stuff, you can do the same thing with trading. So having kind of a pre-performance routine or some type of routine to kind of get you in a rhythm for the day, that's really helpful. I go for a lot of walks and just kind of getting outside, even if they're short walks. A lot of people like to do yoga or go to the gym, but all that kind of stuff really helps be more mindful and in control of your emotions. Having a decision-making process, plays into your trading strategy, and then really having clarity in how you're going to manage the trade. Trying to deliberately think differently, think about, okay, if I'm looking for a long, who might be in the same situation looking for a short? kind of, how a lawyer might think about the other side of the case. Being very intentional, sometimes just having one specific goal for the week. Okay, I'm really struggling with widening my stop. I get in the trade and I just drag my stop wider and hope that it comes back. Be intentional about working on that one thing for the week, master it, and then move on. Taking calculated risks, that's a big part of trading, but you can also think about other areas of life. And I love the saying that, over preparing creates luck, because, there's a lot of things that being in the right place at the right time sure feels like luck, but moving to a city where, your sport, or if you want to play an instrument, moving to Nashville so you're around great musicians, it's not just entirely a stroke of luck that you come across someone at a club or during a gig, and they introduce you to someone else, and then that kind of launches a career. So challenging any negative thoughts that you have with a positive reframe is also something that, far beyond trading, is a very, very good way to get out of a slump as well. So just kind of some higher level mindset things, but boy, do they make a big difference. The small things done over and over again, day after day, do make a huge difference in the long run. So that's what I have for you. The trading strategy, and then those pieces of the mindset and trading psychology, those were pulled from a larger kind of a bigger masterclass. So if you go over to EminiMind, you can find the full masterclass on those things, and I've got a whole bunch of other articles and things that I've put together over at EminiMind related to both strategy and mindset. So thanks for having me, Dave, and thanks everyone for tuning in. I hope you have a great rest of your day.